I would. I think the Fed is behind the curve. The Fed knows it's behind the curve. So there's no surprise there. I think the real challenge for the Fed will be once it starts, and remember, it's still easy policy right now. So once it starts to tighten policy by either increasing rates or shrinking its balance sheet or both, sticking to their guns, because their habit is to kind of reverse course whenever they encounter a resistance or a surprise in the markets. And that's where the real test will come. There's agreement they need to raise rates, even among the FOMC. From what I'm reading, their test will be on systematically staying on the course through some bad news, unemployment rises, market turns back. That's when I worry about them turning around their policy.
So you think they should stay the course even if, say, yield curve inverts, credit risk continues to rise, like we start to get some real recessionary signals from the market, even then?
Well, they better stay the course, because this stop and go policy, they've tried that in the past, and it usually creates more uncertainty. It also creates a more volatile environment. Their credibility then becomes even more at risk. So, I'm not saying they should start raising rates 100 basis points. That would only shock the market. But once they know they're behind the curve, and they are at 7.5%, once they know they have to raise rates at some pace, then they need to set that out for the public and stick to it. Because if they start raising it and they get 75 basis points and the market or the economy starts to slow, unemployment starts to rise, and they back off of that, they may, for a temporary period, kind of staunch the increase in unemployment, but they still will have a inflationary problem. They'll still have to start again, and it will confuse the market. So they've got to get their policy in line and stick with it.
But President Hoenig, my question, which kind of was implicit in Sarah's first question, is how did we get here? How did we get to a point where a senior member of the team was forced to question the credibility of his own team? And why didn't we therefore hike at the last couple of meetings if that's the strength of opinion that exists? And I guess what I'm asking is perhaps there's still just great division amongst the ranks, and there's a chance that we still won't hike in March if those that have an opposing view to Bullard win the day.
I don't think there's all that much dissent based on the speeches I've read. I think the real question, though, is the divide comes when the unemployment rate starts to rise. The divide comes when the market gets unsettled because of the rate increases. That's when the real test will come to the Federal Reserve. Now, why did they get so far behind? Because they have a strong bias towards ease, a strong bias against upsetting the market, and a strong bias against slowing the economy. They want to make things good for everyone, which is a very nice thought. But the fact of the matter is, inflation was clearly on the rise, and on a consistent basis more than 7 months ago. Or 8 months ago, even. So their desire to not slow the economy down is why they hesitated. It's common.
But I think it's also fair to say that it was hard to tell how much of the inflation would stick and would rise. I think it surprised everyone, right, how strong inflation has risen and how fast and how long this has gone on. At first, it did look pretty transitory as far as some of the supply chain issues. Clearly, now there's a realization at the Fed that this is more problematic. What's your forecast on where inflation goes as the Fed does start to tighten policy?
Well, the first thing is, yes, they were concerned. They thought there might be transitory effects of inflation. But the fact of the matter was they were increasing their base money, their reserve purchases of government securities at $120 billion per month, well into the recovery. So that the momentum was already in place. And that's what I find difficult to explain on their part. Now, going forward, I think inflation has become much more embedded. So it's going to take a more extended period of time of higher rates, They're going to have to be concentrating on their balance sheets, now $9 trillion. In 2008, it was $1 trillion. So they have a big job ahead of them. They've got to get their plan in place as to how they're going to deal with this and how they're going to do it in a systematic and persistent way, so they're not doing stop and go policy through the next 3 to 4 to 5 years. That's what will be most harmful to the economy.